Hello, guys, and welcome to the last knockings of our paper number one, your accounting. So, we are at the last knockings of your whole syllabus for accounts, paper number one. Okay, the last chapter which we were discussing in the last class was the ratio analysis. And today we are going to complete most of the ratios today itself, and your course will be done today itself. So, this lecture is going to be a bit lengthy. Just bear with me with all the explanations which we are going through in the today's class, because today's class will be very, very important with respect to your MCQs. Okay, so without wasting any time, just confirm me if you are able to hear the voice and you can see the screen as well as the video. And then we will quickly start with the remaining ratios which were there for the ratio analysis. So this chapter is very, very important, as I mentioned before, because this chapter has some calculations which will be done from your balance sheet, from your P&L, and then you can calculate some ratios which are very easy and very easy to form the questions and very easy to form the answers. But answers can be easy only when you know the concept. So today we are going to have the conceptual knowledge as well as your practical knowledge about this chapter. Okay. So lastly, we have covered some of the ratios already. I told you that there are three types of ratios. That is called your profitability ratio. That is your first part of the ratios. Then you have the activity based ratios. And lastly, you have the solvency ratios. So you have the chart in front of you where we have already covered your gross profit ratio. That is done. We have done operating ratio, and we have also done the net profit ratio. Today we are remaining with the operating profit ratio and expense ratio. So those two will be covered right now. I have prepared one chart for you guys so that you can directly take a screenshot of this chart and you will know all the formulas in one place relating to the profitability ratios, my friends. So these are the all profitability ratios which are important for you. So let us talk about the first one, which we have already done. That is called the gross profit ratio. That is called gross profit divided by the net sales. What do you mean by net sales? Net sales, let us write it down at the bottom so that you do not forget later on. So basically, net sales is equals to your sales minus sales return. Sales is also called revenue from operations. Okay, or it is also called the turnover of the business. So these are the alternative names which you should know for this chapter specifically. Okay, so first was the gross profit ratio. Gross profit, everybody knows how to calculate the gross profit. To take the gross profit divided by the net sales, multiply by the 100, whatever ratio you have got is the gross profit ratio. We have done some questions while we calculated the gross profit in the last class, right? Moving on, we have the net profit ratio, where we calculate the net profit divided by the net sales multiplied by 100. So that was also done in the last class. And then we did the operating ratio. This ratio is also called operating cost ratio. So what this operating ratio does, it computes or it equates the operating cost, which is your cost of goods sold plus other operating expenses. Operating expenses mean which are related to the business. So if I talk about interest, that is a finance expenditure, it won't be included in your operating cost. So remove the financial element from all expenses, you will get the operating cost. Divide that operating cost with the net sales, so you will get to know that what is your operating cost ratio. Okay, and whatever is your operating cost ratio, if I subtract 100 from it, so I will get the operating profit ratio. That is a very simple formula, because cost plus profit is equals to the sale price. In the same way, here also we are calculating the operating profit as well as the operating cost. So if you want to get the operating profit, I will subtract the cost from the total sales, I will get the operating profit ratio. So operating profit ratio is nothing but your operating profit divided by your net sales multiplied by 100. This was to be covered today. And lastly, we have the expense ratio, which is your total expenses of your business. That might be operating, that might be the financing, every type of expenses divided by your net sales multiplied by 100. So that is the expense ratio. Let us quickly solve one question where we will have to calculate all these type of ratios. 5 ratios you want to calculate from this question. So question is, you have been given a profit and loss account, or I would say trading and P&L account. So we have opening stock, we have purchases, we have sales return, we have gross profit, we have sales, we have purchase return, we have closing stock. So let's say opening stock is 1000, purchases are 20,000, sales return is 2000, sales is 30,000, closing stock is 5,000, and purchase return is 1,000. So total right now on the credit side is 36,000, and here I have 23,000 as of now. So 23 minus 36 will give me a gross profit of 13,000. Okay, that is my gross profit. This will be carried down, and here by gross profit brought down 13,000 to depreciation 2,000 to interest 1,000 to other expenses 5,000 and to net profit. Let's say other expenses are not 5,000 but 4,000. So the figures would be different. Okay, so the net profit is 6,000. That is the balancing figure. So here total is 13,000 again. Now what you all have to do, my friends, you have to now calculate. Okay, you have to now calculate 5 ratios. First, gross profit ratio. Second, net profit ratio. Third, operating ratio. Fourth, operating profit ratio. And at last but not the least, expense ratio by the formulas which we have just calculated. Should I give you the time so that you can solve it first, or you want me to solve this together with you? Tell me. Should I give you the time so that you can solve, or you want to try it first? Sir, we want to try it first. Okay, my dear. Just try. You have 5 minutes to solve this. Be quick. What are your answers, guys? Please send it in the chat box. Everyone, please send your answers in the chat box. So time's up. Let us solve each ratio one by one, what we need to calculate first. So very simple was the first one. That is the gross profit ratio. It is nothing but the gross profit divided by net sales multiplied by 100. So from our question, we can see that our gross profit is 13,000. So this would be 13,000 divided by net sales. So my gross sales were 30,000 and my sales return was 2,000. So my net sales would be 28,000. 30 minus 2. Multiply it by 100. So we will get our first ratio, which is called the gross profit ratio. So 13,000 divided by 28,000 multiplied by 100. So this is approximately 46.428, let's say for 46.43% approximately. So those who have got this answer, this is the correct. Now let us solve the net profit ratio. So net profit ratio is net profit divided by the net sales multiplied by 100. So we have a net profit of 6,000 divided by the net sales 28,000 multiplied by 100. So this would give you 21.428, that is 21 point, let's say 43 percentage approximately. So that is your correct answer for net profit as well as gross profit ratio. Now let us talk about what is the significance of this ratio. What does this ratio tells? This ratio basically tells that what is the percentage of your net sales you are earning as a gross profit. So let's say if I have made 1 rupee sale, so out of that 1 rupee, 0.4643 is my gross profit. And out of that 1 rupee of sales, I earn 0.2143 paisa of my net profit. So let's say if I am earning, if I am selling 100 rupees is the sales. So what is the gross profit? 46 rupees is my gross profit approximately. In the same way is 100 rupees is my sales. So out of that 21 rupees is my net profit. This is the significance of this ratio, which tells how much percentage of your sales you are earning the gross profit or net profit respectively. The third ratio is the operating ratio. So when we say operating ratio, this means operating cost ratio. This would be cost of goods sold plus operating expenses divided by net sales multiplied by 100. So in terms of operating cost, let us see what things we need to include and what things we need to exclude. Okay, so just focus on right now the operating expenses. So the formula of cost of goods sold, as discussed in the last class, was your opening stock plus purchases minus your purchase return, your closing stock as well, right? So this is your formula for COGS, that is cost of goods sold. Here 1,000 plus 20,000 is 21,000, minus 1,000 is again 20, and minus 5 is 25,000. So I have got my COGS, that is 25,000 rupees. Okay. Now, if you see, you have a figure of sales return as well. So sales return is obviously the adjustment in the sales. Nothing need to be required to be done for this, because this would be nothing but 30,000 minus 2,000. This can be shown as 28,000 net. In the same way, if you see the purchases, so this should be 20,000 minus 1,000. So here in the formula, I have already I've already included this 20,000 plus 1,000, then minus 1,000 and then 5,000. Okay. So for the operating profit, what you can do, you can, sorry, for the cost of goods sold, what you can do, you can write the formula opening stock plus net purchases minus closing stock. And what do you mean by net purchases? That is purchases minus purchases return. Okay. Now what I will add extra? So depreciation, is it the operating expense? Yes, that is used for operation. So depreciation is 2000. I will add that. Sir, interest, that is not operating one. I will not include interest. Sir, other expenses, we can assume that these are operating. So this is 4000. 4000 is other expenses. Whole divided by net sales. Net sales was 28,000 multiplied by 100. So we have cost of goods sold. Okay, so we have 25 plus 4 plus 2. That gives us 31,000 divided by net sales, which is 28,000, multiply it by 100. So my operating ratio is higher than 100. It would be 31 divided by 28 multiplied by 100. That would be 110.71%. Okay. Now, if we want to calculate the operating profit, you will get to know that we are earning operating loss or what? Let's see. So if you are calculating the operating profit, we need to consider only the operating items. So here, if I say my net profit is 6,000, this includes the interest charge of 1,000. This includes the interest charge of 1,000. So what is my operating profit? This would be 7,000. This would be 7,000. And what is my net sales? It is 28,000. Let us multiply it by 100. So 7 divided by 28 multiplied by 100, 25%. That is your operating profit ratio. Okay. Okay, there is one error over here in my COGS calculation. COGS is incorrectly calculated as 25. It should be 15,000. That was a calculation error. So just redo this calculation here. This ratio would come as 21,000 divided by 28,000 multiplied by 100. So this is 75%. Now you can see that your operating profit is 25% and your operating cost is 75%. So total is always 100 because if you add profit to the cost, that is your sales figure itself, right? So this was your operating profit. And last is the expense ratio. So this asks you to do the total of all the expenses divided by net sales and multiplied by 100. So if I do the total of all the expenses, this would be your depreciation 2000 plus 1000 interest plus 4000 of other expenses. So that is 7000 of overall expenditure. Okay, these are all indirect expense. So this expense ratio is also called indirect expense ratio. Okay, So these are 7,000 divided by total sales, that is 28,000 multiplied by 100. That would be again 25%. So coincidentally, these two are matching up. Not always this will match. Okay. So just remember that this is the procedure to calculate all the ratios, which are your profitability ratio, which are your five types of profitability ratio that is in relation to your sales, because we are taking denominator as your net sales. Okay. Everywhere you can see we have taken denominator as net sales and we have multiplied by 100 because we want this answer in percentage form. What do you mean by net sales? Net sales is nothing but your sales minus sales return. And sales is also called revenue from operation or turnover. Okay, now let us calculate the profitability ratios in relation to the investment, what amount I have invested. For example, in a layman's language, let's try to understand what does this concept mean. For example, there is one company X Limited. Okay, this company is formed by two shareholders, Mr. A and Mr. B. Mr. A has invested 1 lakh rupees. Mr. B has also invested 1 lakh rupees. So the total capital which is employed by the shareholders in this company, the total capital which is employed by the shareholders in this company is rupees 2 lakh. So if this 2 lakh has been invested in this company, out of this 2 lakh, how much return the company has given? So let's say profit for the year was rupees 15,000. Profit for the year was, let's take it simpler, let's take it 20,000. So the calculation would be easy. So now you can see we have invested 2 lakh rupees in this company. How much we have invested? Invested 2 lakh rupees. Out of that 2 lakh, how much is the profit? The profit is 20,000. So what is the percentage of earning? Percentage of earning, or I would say percentage of return that is my shareholder has gotten. So this would be 20,000 rupees. That is the profit which they have got out of the 2 lakh rupees which they have employed in the business multiplied by 100. So I would say they have got a 10% return on their investment. How much return they have got? A 10% of return on their investment. This we can easily calculate logically by the normal method. But here we have some complications available where you need to calculate return on investment. So return on investment is nothing but the same thing which we have calculated right now. That is profit after tax divided by the capital employed multiplied by 100. Whatever capital you have employed in the business multiplied by 100. So what do you mean by capital employed over here? Capital employed means all long-term funds. All long-term funds. Sir, what does this long-term funds means? My dear, it includes equity shares. It includes preference shares and is also include long-term debt. Because what I am trying to calculate here is if I have invested 1 rupee into the business, out of that 1 rupee, how much return I am getting, how much profit after tax I am able to fetch from that business. That is what I am trying to calculate. So although long-term debt is not my money, I have to return it after some time. Equity shares is the shareholder money and preference shares is the preference shareholders money. Every money you have to return from the business point of view. But what that business is giving a return That is what we are calling a return on investment, which is made in the business. That is the return from all sources of long-term funds. That may be your equity shares, preference shares, or long-term debt. When we say what is the return to equity shareholder, so now I will not include the long-term funds. We will only include the equity shareholders fund and compare it with my profit after tax. So that is called the return on equity shareholders. Moving on, I talk about return on total resources, that means total assets which are invested in the business. So this would be profit after tax divided by total assets which is employed in the business multiplied by 100. So that is the return on the total resources. And if I talk about overall profitability ratio, that is overall how much I am earning, that would be your operating profit divided by the capital employed, and if you multiply it by 100 you will get the answer in percentage. So that was about your relation to investment. There is last price earning ratio, that what is the market price per share of the company as well as what is the earning per share of the company, that is called the PE ratio. When we invest into stock market, this PE ratio is of very much importance. Okay, let's take an example and understand why this is important. Let's say a company has a market price of 100 rupees per share. Okay, the company has a market price of 100 rupees per share, and company is earning 10 rupees per share. That is the earning per share. This is the market price. This is the earning. So I would say the PE ratio is 10 times. This is for X Limited. Now let's say Y Limited is also another company. It has a market price of rupees 200 and it is also earning just 10 rupees. So if I say here the price earning ratio is 20 times. So price earning ratio is become higher. That means this share is more expensive compared to the share of X Limited. Higher the price earning ratio, that means higher is the market price than the earning per share. So that is the number of times your market price is higher than the earning per share. So 10 times, that means if I am earning rupees 10, my market price is rupees 100, while Limited is earning 10 and it has a price earning ratio of rupees of 20 times. So that means it share price is rupees 200. So higher the PE ratio, higher is the risk. Okay. Okay, my dear. So that was the price earning ratio. Related to this, I have some other ratios which I'm going to discuss with you guys. That is called payout ratio, dividend yield ratio, and debt equity ratio. Debt equity will come under the solvency ratio. So let's discuss the payout ratio first. Payout ratio means whatever the company has earned, that is the earning per share. Out of that money, how much company has declared the dividend and it has given it to their shareholders. So dividend per share divided by the earning per share is the payout ratio. Let's say company has earned 10 rupees per share and company has declared 8 rupees dividend per share. So I can say that here 80% of the company's earning is distributed as a dividend. This has been paid out to the shareholders. So that is why it is called payout ratio, my friends. Sir, what the company is doing for the remaining 2 rupees? So 2 rupees is reinvested in the business, reinvested in the business. That is not distributed to the shareholders, but it is in the company itself. Company will use that retained earnings for employing into the business, and then they can grow their profits and capital. Okay, so this is called payout ratio. And we have one more ratio that is called dividend yield ratio, that compares the dividend per share with the market price per share. Let's say the dividend is declared as 8 rupees and market share is, let's say, 800 rupees of the company. So I will say that only 1% is the dividend yield of the company. Okay, how I calculated 8 rupees divided by 800 multiplied by 100. So 1% is the dividend yield of the company, that if the market price of the share is 800, out of that 800, only 8 rupees has been distributed as a dividend, and that is called the dividend yield ratio. That is also used when we invest into stock market and into the shares, that which share has a higher dividend yield ratio. So the company which has a higher dividend yield ratio, that means it gives a lot of dividend. Okay, there are some companies in our stock market that gives a higher dividend compared to others. Okay, moving on, my friends. That was all about your profitability ratio. Sorry. Any doubt, anyone? Any doubt in the profitability ratio or their interpretation? Should I move ahead? See, I can see so many attendees over here, but there is so less responses. This demotivates us when we are teaching. So for my motivation, my friends, can you just reply if you have understood the concept? If not, just let me know. I can revisit any of the topic. Are you getting it? Is it crystal clear? Lovely. Okay, great. Moving on to the activity ratios. Activity ratio means what? There are various activities in the company. Okay, I've received one doubt. Let us clear that first. Sir, please explain the investment one, return to investment. So basically, return on investment or return to investment means what? Whenever, let us take one example and then understand it. Let's say I have a balance sheet where you can see that we have liabilities and we have assets. In the liabilities, we have, let's say, equity share capital, 1 lakh rupees, preference share capital, 3 lakh rupees, long term borrowings, 6 lakh rupees. Let's say only this we have in our balance sheet. So how much money I have invested into my company? Sir, in the form of equity share 1 lakh, in the form of preference share 3 lakhs, and in the form of long-term borrowings 6 lakh. Total money invested is, my friends, 10 lakh rupees. Now, if I say out of this money, company has earned a profit of rupees 2 lakhs. Company has earned a profit of rupees 2 lakhs. So if I say what is the return I have received on my investment? So for that, you will need your profit divided by your capital employed in the business multiplied by 100. So what is the profit I have received right now? It is 2 lakh. Capital employed is 10 lakhs multiplied by 100. So I have got a return of investment of 20%. That means if I invest 100 rupees in the business, out of that 100 rupees, I am getting 20 rupees as a return from this business every year, my friend. Okay, so out of that 100 rupees invested, I am earning a profit per annum of rupees 20. So that is the concept behind return on investment. So if there is one question and they ask, is return on investment higher the better or lower the better? So the answer would be, what would be the answer? Answer should be higher the better. Why higher the better? Because as much as return I get, that would be my profit. That would be my profit. Let's say if I've invested 100 rupees and I have got a profit of 100 rupees. So that is the 100% return. That is very good for anyone. Okay. But that is practically not very much possible unless and until you have drawn for a lottery or you are playing some gambling. Okay. Normally the business earns less compared to the 100%. So that is how we can say the ROI should be higher the better. So that was about your ratios of profitability. Now let us go to your activity based ratios. Now I am going to tell you one trick to understand what is the activity. So activity means what is your inventory status? What is your debtor status? What is your creditor status? What is your fixed asset status? What is your working capital status? And at last, what is your capital status? Okay. All the balance sheet items have been taken care over here. So when you think of inventory, inventory is what, my friend? Your stock. Inventory is your stock. So when they ask inventory turnover ratio, always put average inventory in the denominator. In the same way, if they are asking debtor turnover ratio, always put the average accounts receivable, or I would say average debtors in the denominator. If they're asking creditor turnover, so this would be average creditors in the denominator. If they are asking fixed asset turnover, then fixed assets in the denominator. If they are asking working capital turnover, then working capital in the denominator. And they are asking capital turnover, then lastly, capital employed in the denominator. But what should be in the numerator, that will change depending upon the activity. Let's say if we are talking about inventory, so inventory is closely related to our sales. Inventory is closely related to our sales. So here we have taken the cost of goods sold, COGS. Cost of goods sold divided by the average inventory would give you inventory turnover ratio. That is the formula. Now let us understand what is the significance of inventory turnover ratio by an example. So you have a opening stock rupees 10,000. You have a closing stock of rupees 30,000. you have purchases of rupees 4 lakhs. Okay, you have been asked to calculate inventory turnover ratio. So everybody in this class now know the formula. So they are asking inventory turnover. So in denominator, what I will take? Average inventory. Sir, but you haven't told what do you mean by average inventory? So average inventory is your opening stock plus closing stock divided by 2. Just simple average. Okay. So in my case, the opening stock is 10,000. The closing stock is 30,000. So 10,000 plus 30,000 whole divided by 2. This would give me rupees 20,000. This would give me rupees 20,000. This is my average inventory. So in the formula, I can put rupees 20,000 in the denominator. Now in the numerator, it should be cost of goods sold. Okay, that is the turnover of your goods. So cost of goods sold is opening stock plus purchases minus closing stock. So in our question, I have 10,000 opening stock. My purchases are of 4 lakhs and my closing stock is of 30,000. So my COGS is 3 lakh 80,000. Now you can see I have got the COGS. I can put it into the numerator. So 3 lakhs 80,000 divided by 20,000. That would give me, my friend, 26 times. The answer is in times, 26 times. This implies what? That means your inventory has converted into sales in the whole year 26 times. This ratio is also higher the better. That means your inventories keep on rotating in the business. Okay. You can see the figures over here. See, you have purchased 4 lakh rupees of goods and you have just left with 30,000 rupees of goods. That means all the goods which I have purchased that has been sold. So my inventory is fast moving. This is called a fast moving inventory. And if your inventory is fast moving, that means your goods are easily being sold. But if your inventory was slow moving, that means there is the problem with the sales, and it might be a sign that the company may incur some losses due to inventory. So slow in moving inventory is not preferable, but yes, fast moving inventory is preferable. So if I say my stock has been rotated 28 times, so let us calculate in how many days it is being rotated. Okay, so in a year, I have 365 days and my stock has rotated how many times? 26 times. Okay, so 365 divided by 26, that would be 14.038, that is 14.04 days. I would say in 14, every 14 days, whatever I am purchasing in 14 days, it is becoming sales. It is becoming sales. So what is the formula which I have just derived? It is your period period can be 365 days. You can take months also. Okay, if I take it as a month, 12 month divided by 26 times. So this would be 12 divided by 26. Answer would be 0.46 month. So whatever period you want, you can take the answer in that case. So period divided by the inventory turnover ratio. So you will get the rotation of inventory. That may be in days, in week, in month. But always remember, if nothing is given, you can take 365 days. But if question is saying, assume 360 days in a year. So you need to take 360 in place of 365. Question is saying, assume 12 months in a year. So take 12 over here. Question is saying, take 52 weeks. So take 52 weeks. That depends on the data what they have given. Okay. So that was all about your inventory turnover ratio. In the same way, we are going to calculate your data turnover ratio. So data is relating to your sales, right? What sales, which is the credit sales. So in the numerator, we have taken the credit sales divided by average debtors. Average debtor means what? Sir, opening debtor plus closing debtor divided by 2. Now let us see creditors turnover ratio. This is nothing but opening creditor plus closing creditor divided by 2. Okay. Then we have fixed assets turnover ratio. Okay, before going to fixed asset turnover ratio, let us do one question for data turnover ratio and one example for your data collection period as well as your credit period enjoyed. Okay, credit period enjoyed and your data collection period. Let us do one example on each of them. Everyone, just write this. Opening data rupees 40,000. Closing data rupees 60,000. Total sales rupees 7 lakhs. And it is given that 30% of total sales is cash sales. So first information opening data, second closing, third total sales, fourth 30% is the cash sales, fifth opening creditor rupees 30,000, closing creditor rupees 50,000. Sorry. This would be seventh. Total purchases. Total purchases would be rupees 5 lakhs. And last information, 20% of total purchase is cash purchases. What you have to do out of this information? You have to calculate debtors turnover ratio and creditors turnover ratio. So let us solve this question together. Okay, what they have given us and what we have to find. Let's focus on that. First, we have to find the debtors turnover ratio. So the formula for debtors turnover ratio, I've said that if it is a turnover ratio for debtors, so take the average debtor in denominator. And what is the turnover? What determines the turnover of debtors? That is determined by the credit sales. Because obviously, if you sell on credit, then only the debtors are generated. Yes or no? Yes, sir. So, what is the credit sales? Is there any information about credit sales? Yes, sir. They have given that 30% of the total sales is the cash sales. That means, can I say 70% is the credit sale? Yes or no, my friends? So 70% is the credit sales. Total sale was 7 lakh. Out of this, 70% is the credit sale. So do the 70% of your 7 lakhs. So this would give you 4 lakh 90,000. That is your credit sales. And what is your average debtor? Opening debtor 40,000 plus closing debtor 60,000 divided by 2. So 40,000 plus 60,000 divided by 2 will give me 50,000. So here 4 lakh 90,000 divided by 50,000. The answer is 9.8 times. Sir, what does this 9.8 times means? That means out of your all the sales throughout the year, 9.8 times I have received the money from the debtors. So if I want to calculate debt collection period, that in how many days I am collecting the money from my customer. So this would be whatever period you want. Let's say they have asked you to take a 365 days period. So your numerator is in days divided by debtors turnover ratio. So the debtor turnover ratio was 9.8. So divide 365 by 9.8. This would give you 37.24 days. That means in every debtor is paying me after 37 days. They are not paying me instantly. They are paying me after 37 days. That is called the debt collection period. Similarly, we are going to calculate the creditor turnover ratio. So what is the creditor turnover ratio? Is total credit purchases divided by the average creditors. So what is credit purchases? Here you can see the total purchases is given as 5 lakh rupees, out of which 20% is the cash purchases. That means 80% is the credit purchases. So 80% of 5 lakhs is 4 lakhs. So my credit purchases are 4 lakh. Let's write it down. So my credit purchases, the numerator is 4 lakhs. What is the denominator? The opening creditors are 30,000, closing creditors are 50,000. So 30,000 plus 50,000, just doing the average, that would be 40,000. So 40,000 is my average trade payables. So 4 lakhs divided by 40,000 is 10 times. And if I say how many days I am enjoying the credit, so credit period enjoyed, that would be your period, that is, let's say 365 days divided by the creditor turnover ratio, that is 10 times. So I would say 36.5 days I am taking to give back the money for the goods which I have purchased. So this is the period which I am enjoying on credit. Okay. I have taken the goods and after 36 days, I am returning back the money. So that is the creditor credit period enjoyed and creditor turnover ratio. Okay. So these were the two formulas which I was going to tell you later on, but we have now completed. The formula for the debt collection period is period divided by debtor turnover ratio. The period may be 365 days, 12 months, 52 weeks, etc. In the same way, credit period enjoyed is period divided by the creditor turnover ratio, my friends. Okay, moving on to next activity ratio, that is called fixed asset turnover ratio. This is the simplest one where you just need to in rest of the three. Okay, always and always take net sales in the numerator, and whatever is the ratio, take that in the denominator. For example, this is the fixed assets, so net fixed assets. This is the working capital, so working capital over here. This is the capital, so capital over here. It is very, very simple. Okay, and we have one more formula, that your capital turnover ratio is nothing but your fixed capital plus working capital. So if you have been given with the fixed asset turnover ratio, you have been given with the working capital turnover ratio, you can find out the capital turnover ratio as well. Okay, that would be obviously equal. So if I say the fixed asset turnover ratio is 10 times, working capital turnover ratio is 14 times, so capital turnover ratio would be your 14 times. Okay. Then we have the solvency ratios. Solvency ratio indicates what is the position of your liquidity, that will you be able to pay the money which you have taken. So that is categorized into long term and short term. Okay, you need money to pay your long term debts. Sir, who are my long term debts? Obviously the bank loan which you have taken. Okay, so how much money you have taken the loan from the banks, how much capital you have employed by yourself. So this is the comparison of your long-term solvency. Then we have short-term solvency. That means how much current assets you have to pay your current liability. So let us do the short-term solvency ratios first. So we have current ratio, that is current assets divided by the current liabilities. So all the current assets will be added and it will be divided by your current liabilities. Everybody in this class already know from the previous lecture that what are the current assets and what are the current liabilities. So add all the current assets divided by current liabilities, you will get the current ratio. Sir, is there any ideal current ratio? Yes, my friend. The industry has prescribed 2:1 as the ideal current ratio. That means 2:1 means what? 2 divided by 1. If I say 2 divided by means what? That is current asset divided by current liability. This means, my friend, for paying off every 1 rupee of the current liability, I should have two sources. Okay, I should have double the money to pay off 1 rupee, because there might be the case if I am not having sufficient current assets to pay off my current liability, my business will shut down in the short term itself. My business is not going to work. So they say that ideal current ratio is 2:1. For every 1 rupees of the liability, you should have 2 rupees of your backup. 2 rupees of your backup as your current assets. So that is the ideal current ratio. Then we have the liquidity ratio, or I would say not liquidity, but it is called the liquid ratio. It is also called quick ratio, and it is also called acid test ratio. So why it is called by so many names? Because here what they do, in place of current asset, they are taking the quick assets. Why they are taking the quick assets? Because in your current asset, you have your stock and your prepaid expenses. Okay, but in the quick asset, from the current asset, you exclude the stock and the prepaid expenses, and whatever amount you get, that is the amount of your quick asset. And that quick asset should be compared with your current liability. So why they are excluding the stock as well as the prepaid expenses? Because my dear, stock, you never know when it will be sold and when you will get the money. Okay, when it will be sold and when you get the money. And prepaid expenses is nothing but you have already paid for this. I am already paid for this, but it is showing in the asset size because we are yet to receive the benefit from it. We will never receive the cash from the prepaid expenses. We will receive the services from the prepaid expenses. So that is why we have deducted the stock and the prepaid expenses. Now, whatever I am remaining with is called the quick assets. This assets can be sold. This can be your cash in bank. This can be your debtors. This can be your short-term investments. This you can sell and you can pay off your current liability. So ideal quick ratio, there is an ideal quick ratio as well. Ideal quick ratio is 1:1. That at least for every 1 rupee of the liability, you should have 1 rupee of the quick assets. That is rupees 1 divided by rupees 1. This rupees 1 is your quick assets, and this rupees 1 is your current liability. So for every 1 rupee of your quick asset, you should have your current liability. Sorry, you should, for every 1 rupee of your current liability, you should have rupees 1 of your quick asset, my friends. Is it clear? So that was your quick ratio. Let's do one example and then we will move forward. So I'm giving you some information. Let's say debtors rupees 10,000, creditors rupees 5,000, stock 12,000, cash 13,000, bank balance 20,000, bank overdraft 10,000, or take it as 7,000, outstanding salary 3,000, prepaid expenses 5,000. Calculate current ratio and quick ratio. Calculate the current ratio and the quick ratio. So now everybody can see what is your current asset and what is your current liability. We are calculating the current ratio first. Let's calculate the current ratio. So first I have my debtors, that is my current asset. So let's add 10,000 in the numerator. Then we have 5,000 rupees creditor, that is your current liability. So we will add 5,000 in the denominator. Then we have stock, that is again your asset, plus 12,000. Then we have cash 13,000, that is asset. Then we have bank balance of 20,000, again an asset. Then we have bank overdraft, that is a liability. So that is current liability 7,000 rupees. We have an outstanding salary of 3,000, that is also your liability. So what I will do, I will add the 3,000 in the current liability. Then we have prepaid expenses of 5,000. So that will be added to your numerator as an asset. So let's do the total of all these. So we have 10,000 plus 12,000 plus 13,000 plus 20,000 and plus 5,000. So we have total current assets of 60,000, in return to which I have a current liabilities of 15,000. So what is the ratio over here? This is expressed in the form of a ratio. So this is 4/1, or I can say 4:1. So is it good? The answer is yes, it is good. Why it is good? Because to pay off 1 rupee, I have 4 rupees of backup. In the same way, to pay off 15,000, I have a backup of 60,000 rupees, my friends. That is the current ratio which we have calculated. In the same way, we are going to calculate the quick ratio. So quick ratio is quick assets divided by your current liability. What is your quick asset? Quick asset is current assets minus stock minus prepaid expenses. So we are excluding the stock and prepaid expenses from the current assets and dividing it by current liabilities. So current liabilities was 15,000. What was my current asset? It was 60,000. How much was my stock? Sir, my stock was 12,000 and my prepaid expenses were 5,000. So deduct 12,000 as a stock and 5,000 as prepaid expenses and divide the whole by 15,000. So this would be 43,000 divided by 15,000. So let's cross out the zeros and divide 43 by 15. So this would give you 2.866. So let's take 2.87 divided by 1, or we can say 2.87 is to 1. So for every 1 rupee of my current liability, I have 2.87 quick assets to pay that current liability. So my business is very, very solvent. I have the money and I can pay off anytime I want. Okay. Is it clear? Any doubt, anyone? Okay, lovely. Perfect. So that was your quick assets. We have done with the quick assets, quick ratio, and the current ratio. Now there is one more ratio which is called super quick ratio. See, my friends, we have one more ratio which is called super quick ratio. Why it is called super quick? Because from your current asset, you were excluding the stock and the prepaid expenses to calculate the quick assets. But for the super quick, you also need to deduct the debtors also. Because you never know when your debtors are going to pay you in 1 month, 2 month, 3 month, or what. So for the super quick, we are deducting the debtors. So in the same example which we have done right now, let us try to calculate the super quick ratio. Super quick ratio. So this would be your quick assets minus debtor. Quick asset, we have already deducted the stock and prepaid expenses from this. We just need to deduct more what? Debtors. So quick assets minus debtor divided by your current liability. My quick assets were coming to be 43,000 and my debtors in my question were 10,000 rupees. So this would be 10,000 and my current liabilities were 15,000. So this would be 33 divided by 15,000. So my super quick ratio is 33 divided by 15. 2.2 divided by 1, or I can say 2.2 is to 1. So for every 1 rupee of the current liability, I have super quick assets of rupees 212. Okay. In a similar way, for 15,000 of liability, I have 33 super quick assets available, which can be used to pay off this liability. So this is called short-term solvency ratios. Going back to our chart, You can take the screenshots of the charts because it is very, very important to have whole overview in one page. Okay, so we have done the current ratio, we have done the liquidity ratio. Last but not the least and very, very important one is the interest coverage ratio. So what is the interest coverage ratio basically? That means how much profit you have to pay off your interest. How much profit you have to pay off your interest. Is your interest have a sufficient coverage on your profit or not? So let us take an example. You have given profit after interest rupees 50,000. Interest for the year rupees 10,000. Find out interest coverage ratio. So let us find out the interest coverage ratio and then learn the significance of the interest coverage ratio. So interest coverage ratio, the formula is profit before interest and tax divided by the interest amount. So here I have got profit after interest. If we want to go before interest, so I can add the interest, yes or no? So in the profit after tax, if I add the interest, so I will get the profit before interest and tax. I do not have any information on tax, so let us assume that tax is 0. But if tax was also given and you have been given profit after tax, then you can add back the tax also. So here my profit after tax is 50,000, profit after interest is 50,000 and interest amount is 10,000, whole divided by the interest amount that is 10,000. So the total here is 60,000 divided by 10,000. That means 6 is to 1, 6 by 1, or you can say 6 times. Okay, so you can see that you have 6 times of your profit compared to your interest. So there is 10,000 rupees of interest charge, but you are making a profit of 6,000. So you have a sufficient amount of profit so that you can pay the interest to your long-term debt. Okay, so you can pay off your interest to the long-term debt. This is very, very important. Higher the ratio, better is the situation of the company. So this ratio is higher the better. This ratio is higher the better. Sir, what happens if this ratio is lower? Let's say the company has a profit of 10,000. Profit before interest. It is 10,000. And then you have been given with the interest amount of, let's say, 25,000. 25,000 is the interest. So what is the profit after tax, my friends? My profit before interest is 10,000. Okay. This is profit before interest and tax. It is also called EBIT, that is earnings before interest and tax, or PBIT, that is profit before interest and tax. If this is given to you and you have an interest amount of 25,000, so what is your profit after interest? It is negative 15,000. The company is making loss. The company is earning only 15,000, but it has a financial liability, financial burden of 25,000, and it is very negative for the company. So in this way, if you calculate the interest coverage ratio, it is 10,000 divided by the interest amount of 25,000. So this is 0.4, my friends. 0.4. That means my profit is insufficient. Whenever it is less than 1, it means profit is insufficient to cover interest expense. To cover the interest expense. Because if you are not able to pay the interest, you won't be solvent in the short term as well as in the long term. You are earning the profits, but still it is not enough to pay off your debts. Okay, so this ratio is always higher the better, as much as higher the better. Okay, moving on. So let us understand now the long-term solvency ratios. The first long-term solvency ratio is debt equity ratio. In the name only we have the formula, that is debt divided by equity. Okay, that is divided by equity. That means how much of the debt you have in comparison to your own funding. How much the company is into the debt, or how much the company has invested themselves by the shareholders in comparison to the debt. Debt is the long-term borrowings of the company and equity is the shareholders fund. Then we have the proprietary ratio, which shows how much percentage of the total tangible asset is financed by the company's equity. How much percentage of the total tangible asset is financed by the equity, because the balance one would be financed by the long-term debts. Okay, or I would say your working capital. No, not the working capital, but your long-term debt. Sorry. So how much your tangible assets are being financed by your shareholders equity. Then we have the fixed asset ratio. So it is the similar one which we learned over in the activity ratio, I think. So fixed asset ratio was already covered. Yes. Net sales divided by the net fixed assets. So just remove it from the solvency one. Not required. In the same way, we have a capital gearing ratio. This ratio is again very, very important. Then this ratio shows how much times is your shareholders fund compared to the fixed interest bearing funds. Sir, what do you mean by fixed interest bearing funds? Obviously, your long term borrowings would be covered into this. But this will also include one more thing, that is preference share capital. Because on preference share capital, you need to pay fixed dividend. You need to pay a fixed amount of dividend. So that is also your fixed return bearing fund. And here you have to pay fixed interest. So you cannot avoid this to expenditure. So your fixed interest bearing fund would include your long-term borrowings as well as preference share capital. So then what this shareholder fund means? This means your equity shareholders fund. Equity shareholders fund. So if I calculate this ratio, that means how much amount we have taken from outside whom I need to pay the fixed amounts compared to the ones who I can pay the flexible amount. Okay, that is called the capital gearing. How much capital is taken from outside having the fixed interest bearing funds, and how much is my own amount invested in the company. So these all are formulas, my friend. You need to by heart learn those formulas. By the name also you can judge many of the formulas yourself, but some you need to keep a special focus on this type of questions. Okay, so let us do some questions from your book as well and just have an overview what we have covered till now. So in the profitability ratios, we have the overall profitability, that is your operating profit divided by the capital employed. We have covered this. Price earning ratio is the market price per share divided by the earning per share, PE ratio, which I have told you. Okay, gross profit we have already covered, net profit we have already covered. Then we have the operating profit ratio. Just see the significance also, which we have discussed when learning the ratio. So every ratio has their own significance. This might be asked as a 1 mark question as MCQ, so you need to know about that. Then we have fixed charges coverage ratio, that is EBIT, earning before interest and tax, divided by the interest. So here this is also called your interest coverage ratio, which we have learned just now. Then we have payout ratio, that is dividend per share divided by the earning per share. Then we have dividend yield ratio, that is dividend per share divided by the market price per share multiplied by 100. Okay. Then we have return on shareholders fund, that is net profit after interest and tax divided by the net worth, that is your capital employed multiplied by 100. Then we have your activity ratio, that is overall turnover ratio, that is net sales divided by your capital employed. Then we have fixed asset turnover ratio, that is net sales divided by your fixed assets. Then you have debtor turnover ratio, we have credit sales divided by average account receivables. Debt collection period we have already covered. We have the number of month or days divided by the debtor turnover ratio. In the same way, we have covered for the creditor turnover ratio, that is your credit purchase is divided by your average accounts payable, and we have credit period enjoyed, that is your period divided by the creditor turnover ratio. Okay, moving on to the stock turnover ratio, that is also called inventory turnover ratio. This would be COGS divided by the average inventory. What do you mean by average inventory? Wherever you need to do the average, just do opening plus closing divide by 2. That is your average. If you want to find the average inventory, so opening stock plus closing stock divide by 2. If you want to find average debtors, opening debtor plus closing debtor divided by 2. If you want to find average creditor, so opening creditor plus closing creditor divided by 2. Then we had some financial ratios, that is fixed asset ratios is about your fixed assets divided by the long-term funds. Okay, debt equity ratio is your debt divided by your equity. As I said, the shareholder fund divided by your long-term debt. Then we have proprietary ratios, that how much tangible fixed assets is financed by your shareholder fund. Then we have the solvency, short-term solvency, current asset divided by current liabilities. This is very, very important ratio from the examination perspective. That is the current ratio. Then we have the liquidity ratio, quick ratio, or acid test ratio. This is again very, very important. That is about liquid assets, or we can say quick assets divided by your current liability. What is liquid asset? That is current assets minus inventory minus prepaid expenses. Then we have super quick ratio, where quick assets minus your debtor will give you super quick ratio divided by current liabilities. Then we have defensive interval ratio. So this is missing. This we can do it right now. This is again very, very simple. Whatever liquid assets you had, whatever liquid assets you have, divide it by the daily cash requirement. For example, I have 50,000 rupees in my hand, and daily I need 500 rupees to run my business. So if I cancel this out, this would come 100. This 100 is 100 days. That means from this 50,000, I can run my business 100 days. My cash requirement was 500 every day, and I have 50,000 rupees. That means 100 days I can run my business with the help of my quick assets. Is it clear, everyone? That is called defensive interval ratio. Then we have debt service coverage ratio, that is similar to your what we have learned for interest coverage ratio, but the only change here is you will add profit after taxes plus depreciation plus interest divided by interest on loan plus loan repayment of in the year. Whatever loan you have repaid, that would be added. So that is in simpler form profit after tax plus depreciation. So why we are adding depreciation? Because it is a non-cash expenditure. No cash is going out when we are charging depreciation. And we are adding interest on loan. So basically, it is called profit before interest, tax, and depreciation. PBITD divided by your interest repayment plus principal repayment. That is called debt service coverage ratio. Again, higher this ratio is better, higher the better, because this shows you have more than enough money to pay your installment of your interest and principals. Your debt is being covered by the profit. That is called debt service coverage ratio. That is the concept behind that. Okay. Again, from the name, you can understand this. Some ratios we have in different industries. For example, in hotel, we have the occupancy, room occupancy ratio, bed occupancy ratio, double occupancy, or seat occupancy. So again, for any ratio, you can form the formula yourself. For example, if I want to calculate the room occupancy. So total room and we have occupied rooms multiplied by 100. So occupied room, let's say I have 7 occupied rooms, total room were 10, multiply it by 100. So I would say the occupancy ratio is 70%. The 70% of the hotel is full and 30% is empty. So just you need to apply your brain at that point of time and you can calculate any ratio you want. Similarly, in the transport industry, what is the passenger kilometer? What is the seat occupancy? What is operating cost per kilometer? In the banking industry, we have operating expenses ratio for various period, loan to deposit ratio, how much loan I have given and how much people has deposited into my bank, and we have operating profit ratio for various products. Then we have telecom industry. What is the average duration of one call, outgoing call? What is the number of outgoing call per connection per user? What is the revenue per user? This revenue per user is also called ARPU. That is the average revenue per user. This is an important phenomena for the telecom industry, not for your examination purposes. Okay. And then we have some question. For example, we have illustration number 1, where you have been given with the P&L account of PKJ Limited, and you have to calculate gross profit ratio, overall profitability ratio, current ratio, debt equity ratio, stock turnover ratio, fixed finished goods turnover ratio, and liquidity ratio, my friends. You have balance sheet also and P&L also. So I am giving you 15 minutes, 15 minutes altogether to calculate gross profit ratio, overall profitability ratio, current ratio, debt equity ratio, stock turnover is inventory turnover ratio, then finished goods turnover ratio. So finished goods we have not covered, we will cover it now. It is again a simpler one. And then liquidity ratio, that is your quick ratio. So 7 parts of this question. You have 15 minutes, let's say 2 minutes for each part. Start solving this. This is on page number 347 of your book. 15 minutes. Start it now. If anybody has any question, you can put it in the comment box. Everyone, any comments, any issues or anything, please bring it out to me. Okay, should we solve this question or you need more time? Third 15 minutes are not yet over. Okay, last 3 minutes now. 3 minutes you have, just finish it off and then we will do it together. Okay, guys, time's up. Now let us solve this question together. Okay, so there are many answers which you people have provided. Those answers, most of them are correct, but I am going to tell you a simpler method when you have to calculate so many ratios and very much data is given. Okay, in exam you will have only 1 mark question, so don't expect all these into one. But yes, this is a typical example where we have one data and many questions. So this was a very good example which I should take in the class. That's why I've taken it. Let us see that how we can solve this type of questions, my friends. Okay, now this is your illustration number 1. For simplicity of my data, in the question you can see that they have said this that it is a PNL account, but this is not actually a PNL account because we have the trading items involved over here. So we will prepare our traditional trading and profit and loss account. Okay, so that we have our gross profit. We will also make a section for the operating profit as well, so that we have the values very easily in this. Okay, Let us see what information they have given with respect to everything. So right now they have given you opening stock of finished goods, right? So we have opening stock of finished goods to opening stock of finished goods. Then we have opening stock of raw material. Then we have purchase of raw material to purchase of raw material. Then we have direct wages of 2 lakh. Let us also put the figures. Raw material was 50,000, finished goods was 1 lakh, opening stock, and purchases of raw material was 3 lakhs. Okay. Moving on, we have manufacturing expenses. So we can assume that this manufacturing expenses relate to your direct expenses. So this would give you your 1 lakh rupees. Then we have administration. So administration is never your direct expenses. This is your indirect expenses. So let us take it in the P&L. Administration expenses that we have 50,000. Then we have selling and distribution expenses 50,000. Moving on, we have loss on sale of plant. So this is not relating to my normal operation. Okay, this would come beyond my normal operation. So let us prepare extended P&L. I'm writing it downside to loss on sale of plant. 55,000 it was. Yes. Then we have interest on debentures. So again, interest cost is also not your regular expenses, right? That is part of your non-operating expenses. So we have interest on debenture of 10,000. Let us take it further down to interest on debenture, that is 10,000. Then we have ultimately the net profit. I've considered every item which is on the debit side. Now let us consider the credit side. So we have sales of 10 lakhs. Is there any sales return as well? We can take directly the net sales. No, they have not given any sales return. So whatever is your sales, it is your net sales. Then we have closing stock of raw material and closing stock of finished goods. So closing stock of raw material and closing stock of finished goods. Raw material are 150. Finished goods are 1 lakh. Then we have profit on sale of shares. This is also not operating expenses, but operating income, but non-operating income. So by profit on sale of shares, and that is how much? 50,000. Okay, my friends. Now we are ready to do the calculation, to do the totals, I would say. So let's do the total first of the trading part. So you have 10 lakh of sales, 150 raw material, 150, 1 lakh finished goods. So this would give you 12 lakh 50,000 as a total. And now you have to deduct 12 lakh 50,000 and subtract all the opening items of finished goods, raw material, purchases, direct wages, manufacturing expenses. So it would be 12 lakh 50,000 minus 1 lakh is your opening. 50,000 is my opening stock of raw materials. Then we have 3 lakhs of purchases. Then we have 2 lakh of direct wages, and then we have 1 lakh of my manufacturing expenses. So ultimately, I have a gross profit of 5 lakh rupees. This is the balancing figure. This gross profit will be brought down by gross profit brought down, that is 5 lakh rupees. Okay, moving on, we have some administration expenses as well as some selling and distribution expenses. Now, if I deduct these two, I will get the operating profit because these are part of my operating expenses. So I have 5 lakhs total here. This is 5 lakh total over here. So the balancing figure operating profit is my 4 lakhs. One total is done over here. And this operating profit will go down. And ultimately, we will calculate the profit before interest and tax. I'm going to calculate the profit before interest and tax. One more total. So here the total is 4,50,000. And this would be again 4,50,000. And if I deduct 450 minus 55, profit before interest and tax would be 3,95,000. This is profit before interest and tax 3,95,000. And at last, if I deduct the interest, so I will get profit after interest and tax. Okay, tax is nowhere written in the question, so let us assume that this is profit after tax 3,85,000. Let's do the total 395 and 395. Sir, why you have done so many parts? Because every part has its own significance. I need the interest part, I need the profit before interest, I need profit after interest, I need the interest, I need the profit before interest and tax, I need the operating profit. That is the reason we have splitted this into various other parts. Otherwise, this P&L was also fine. So they have first asked me for the gross profit ratio. Let us first quickly calculate the gross profit ratio from the information. So the gross profit ratio is nothing but the gross profit divided by the sales multiply by 100. So in my question, the gross profit in my solution, the gross profit was 5 lakhs and the sales are 10 lakhs. So this would be 5 lakhs divided by 10 lakhs multiply by 100, that is equal to 50%. That is my first answer, the gross profit ratio, which they have asked for. Then second part they have asked for overall profitability ratio. So overall profitability ratio asks me to calculate the operating profit, which will be divided by the capital employed and multiply by the 100. So basically, what is the operating profit over here? Again, I can take the data from here. My operating profit was coming to be 4 lakh rupees. So simply, I can put up that figure 4 lakh. Sir, what is the capital employed? For that, we need to refer the balance sheet. That was also given in the question. So here you can see the capital employed is your equity share capital of 1 lakh rupees, then preference share capital of 1 lakh rupees, plus the reserves of 1 lakh rupees. That is the capital employed in the form of shares. But we have debentures also of 2 lakh rupees. So 1 plus 1 plus 1 plus 2. Total capital employed is 5 lakh rupees. 5 lakh rupees. So 4 lakh divided by 5 lakh multiplied by 100. The overall profitability is 80%. Gross profit was 50%. Then the third thing which we are required to calculate is the current ratio. So what is the current ratio? That is the current asset divided by the current liabilities. What is the current asset over here? So again, you need to refer the balance sheet. You have fixed assets, you have stock of raw material, you have stock of finished goods, you have bank balance, and you have debtors. So it would be 150 plus 1 lakh 250 plus 50 3 lakhs and 1 lakh debtors is 4 lakhs. So 4 lakh is my current ratio, current assets. What is my current liability? It would be my sundry creditors and bills payable. 1 lakh plus 50,000 is 1 lakh 50,000. So this would come around 2.67 divided by 1, or I would say 2.67 is to 1. That is my current ratio. The third thing which they have asked for. Fourth, debt equity ratio. The name is the formula itself. So it is debt divided by equity. Sir, what is the debt? We have just now seen the debentures. Debenture were of 2 lakhs. And sir, how much was the equity over there? So equity is the long-term fund. Equity is the long-term fund, which would include your equity shares plus preference shares plus your reserves plus your debt. Okay, this ratio is also called debt to total equity ratio. Okay, so basically this would be again 2 lakh divided by 5 lakhs. And this would be written as 2 is to 5. Okay, alternatively, if you want to just take the equity part of it, equity part means the preference shares plus equity shares plus the reserves. So this would be 2 lakh divided by 3 lakhs. So answer is 2 is to 3. Okay, so both the things are correct. Sometimes they take total equity, which includes your debt, but if it is not mentioned total equity, the correct answer is 2 is to 3. You can take this as a reference. Then fifth is your stock turnover ratio. So stock turnover ratio is nothing but your raw material consumed. That means your cost of goods sold divided by the average stock of raw material. So here we have finished goods also and raw materials also. So here in the stock turnover ratio, you will always take the reference of your average raw material. So let's go to P&L back. The opening stock of raw material was 50,000. The closing stock was 150. So 50 plus 150 divided by 2 will give me an average of 1 lakh. Now, sir, I have to calculate the raw material consumed. So the formula is simple. Opening stock of raw material plus purchases minus closing. So opening was 50,000. Closing was 1 lakh. And purchases of your raw material was 3 lakh rupees. So 3 lakhs plus 50 minus 1 lakh will give me 2 lakh 50,000. Okay. Divided by 1 lakh. That would be 2.5. That is your raw material consumed. Okay. Opening plus purchases minus closing stock of raw material. Then we have another part which is asked fixed asset, sorry, fixed finished goods turnover ratio. So then we have finished goods turnover ratio. So here obviously in place of raw material, just take average stock of finished goods. So now you have your opening stock of finished goods, closing stock of finished goods, and all your expenses, that is COGS, you want to calculate. So the COGS will come around. COGS would include your finished goods, opening stock, plus deduct your finished goods of closing stock, your manufacturing expenses, direct expenses, right? So this would be 1 plus 2 plus 1, 6 minus 1. That would be 5 lakh as your COGS divided by average of your finished goods. So average stock of finished good was 1 lakh plus 1 lakh divided by 2 is again 1 lakh. So the fixed asset finished goods turnover ratio is 5 times again. So that was your sixth part, and last part was your quick assets. So what is the quick assets? That is your quick ratio, not quick assets, but quick ratio. So this would be quick assets divided by the current liabilities. So quick asset is nothing but your current asset minus your stock minus prepaid expenses. In this question, we do not have prepaid expenses, so we will just deduct the stock from my current assets. So current asset, I have already done the total while calculating the current ratio. It is 4 lakh rupees. So from this 4 lakh, I will deduct the value of my stock. What is the stock I am having in my balance sheet? So it is 1,50,000 plus 1 lakh rupees, which is the stock of finished goods and the stock of raw material. So 2,50,000 will be deducted. Current liability will be same 1,50,000, which was earlier calculated in the current ratio 150. So this would be 1,50,000 in the numerator divided by 1,50,000 in the denominator, that is 1:1. That was the last part which we needed to calculate. So that was all with regard to this chapter. All you can do is right now solve more and more questions, as many as you can. So you will have more and more of whole overview from this. Okay. If required, we will meet up for solving your doubts and solving more and more questions if you require. But right now, everything is in now your hands. Every concept is completed from my end. This chapter, this course is fully completed with respect to all the concept, right? Now, you have to focus on your studies. You have to clear this exam very fast, and then you have to become a working professional, a professional accountant, that is a certified accountant, right? So this is your chance to prove yourself. You have to show your will, because there, wherever there is a will, there is a way. So that's all from my side, my friends. So this is Ayush Asija signing off from your financial reporting. All the very best. I am there for you. If there are any doubts, feel free to reach me out. You can post the doubts right now also if there are any. I'm ready to take that up. Okay. So see you all. Bye bye. Take care. All the very best again. Thank you. Thanks for all your patience and all your dedication towards your studies and your concentration during the classes as well. Okay. Thank you all. Bye. No, beta. When if there are any doubts, we can cover it up. As far as classes is concerned, all are completed right now. Any other doubts? Anyone? The difference between quick ratio and super quick ratio. There is only difference of daters, my friend. There is only daters of only difference of daters. In quick ratio, how you calculate the quick ratio? You take all the current assets, you deduct the stock from it, you deduct the prepaid expenses from it, and you divide whole by the current liabilities. Versus in your super quick ratio, same thing you will do: current asset minus stock minus prepaid expenses. Additionally, you will also deduct debtors. Then you will get super quick assets divided by your current liabilities. That is the formula right now. Now there is only doubt class. Yes. Bring on your doubts. So that is about your quick ratio versus super quick ratio. Sir, why they are calculating, why there is a need of super quick ratio? Beta, because you never know when your debtors are going to pay. They may pay you after 1 month, they may pay you after 2 months, or they may never pay you. There may be bad debt. Okay, that is also possible. But other than stock, prepaid expenses, and debtors, we have cash that is in my control. We have bank that is in my control. If I have any shares and securities, which I call it as short-term investment, that is also in my control. So anytime I want the money, I can get it from these sources. So this is super quick. So if I need any money to pay off my current liabilities, I can get from these sources. Okay. Any other doubt, anyone? So just wanted to know overall your experience, how you got to understand different concepts from my regular classes over here. Just give me a feedback over comments on the YouTube or wherever you are watching. Okay. Right now, if you can give in the live class, that is also wonderful. It is always great to learn from the feedbacks. If there is anything which you would like to mention, so please mention it over the comments. Okay. Thanks everyone. See you all. Bye bye. Take care.